Hi friends, welcome to my presentation, Property Valuation for Beginners. Really, after my 3 presentations previously, which you might have seen, I received a good number of requests from young valuers who have just joined this profession. They were telling me that all my presentations are for persons who have already in the profession for quite a long time. They requested me to start a presentation of property valuation from preliminary stage. Hence, I have prepared this presentation, Property Valuation for Beginners, in 8 parts. And this is the first part. After knowing the response from the viewers, I shall continue with the other parts. This presentation has been prepared in a very simple manner with utmost care to give even the simplest and the basis of valuation for the benefit of the valuers who are in the beginning stage in this profession. Value is defined as the worth or utility of a thing. Worth as estimated, amount for which a thing can be exchanged. Cost, price and value. Cost. It is the expenditure to produce a commodity having a value. Price. It is the cost of the commodity plus additional reward to the producer for his labor and capital. Value. Value is inherent in the property itself, but will be determined by the forces like demand and supply. Value is a function of time, place, and purpose. Value is an estimate or assessment of what price ought to be. Different kinds of properties for which the valuation is generally required. Land and building, stocks and shares, agricultural lands, plant and machinery, plantations, jewelry, mines and quarries, works of art. Purpose of valuation. Equitable mortgage. Purchasing for self-occupation. Income tax purposes. Present value of old property for investment, purchasing and selling. Housing loans. Educational loans. Market value. It is defined as the sum the property will fetch if it is sold in an open market. Guideline value. It is the value of the land which is recorded in the Register of Registration Office and used for the purpose of determining the stamp duty at the time of registration of the document. Book value. It shows the original investment of a company as the assets including properties and machineries less depreciation for the period past. Salvage value. It is the value of the property realized on sales when its useful span of life is over, but still it has not become useless. Scrap value. It is called the junk value or the breakup value or demolition value. It will represent the value of the old materials in a building less cost of demolition. Disposal value. It is defined as the value that can be realized if the assets were to be removed from foundation and sold as separate standalone items. Insurance value. It is the value of the building for which the building is insured. Normally, the building is insured for the superstructure alone. It is the present value of the property which will start yielding an income in future. Potential value. It is an inherent value which may go on increasing due to passage of time or some factor which will fetch more return. Distress value. If a property is sold at a lower price than that which can be obtained for it in an open market, due to particular reasons, it is said to have distress value. This is mainly due to financial crisis of the vendor, panic due to war, riots and earthquakes, floods, landlocked land, sentimental reasons, then nuisance value. Speculative value. When the property is purchased so as to sell the same property at a profit after some duration, the price paid is speculative. Monopoly value. In a developed housing colony, the value of the plot goes on increasing when the number of available plots goes on decreasing. The fancy price demanded by the vendor for the remaining plots is known as the monopoly value. Sentimental value. The extra price which is demanded by a builder or vendor when he attaches certain sentiments to his property is known as sentimental value. Fancy value. It is called the desired value. If the purchaser wants to have a property somehow, since the procurement is an absolute necessity for him, due to various reasons, he is prepared to pay more sum when compared with others. He attracts a special desire over the property. The extra sum he is prepared to pay is called the fancy value. Accommodative value. Small strips of lands cannot be developed independently due to their restricted lengths and depths, etc. And number of purchases for this type of property is less. These strips could be sold only to the adjacent landowners who may be offering only a low price. This is called accommodative value. Replacement value. Replacement value is the cost of reproduction of a similar building with similar specifications at the current market price on the date of valuation. It is also called as reproduction value or reinstatement value. Depreciation value. It is the reduction of the value of the property due to age, deterioration, lack of maintenance, decay, wear and tear, etc. Depreciation value depends upon the age and its future life. Present value. It is the replacement value less depreciation. Equitable value. Equitable value is the estimated price for the transfer of an asset or liability between identified, knowledgeable and willing parties that reflects the respective interests of those parties. Investment value or worth. Investment value is an asset to a particular owner or prospective owner for individual investment or operational objectives. Synergistic value. Synergistic value is the result of a combination of two or more assets or interests where the combined value is more than the sum of the separate values. Liquidation value. Liquidation value is the amount that would be realized when an asset or a group of assets are sold on a piecemeal basis. Market rent. Market rent has been adopted as basis of value by the international valuation standards, although It is a periodic flow of benefit and not a capital value of an asset. Factors affecting value of properties: supply and demand, Rent Control Act, cost of reproduction, Urban Ceiling Act, Occupational Value, Town Planning Act, any abnormal conditions like war or riots. Valuation approaches. There are three principal approaches of valuation generally used by the valuers. 1. The market approach. 2. The income approach. 3. The cost approach. Market approach. The market approach is an approach based on methods of direct capital or sales comparison and is the simplest method for valuation. The income approach to valuation of real estate is an income capitalization technique adopted from the investment market principles under accounting discipline. Methods of valuation: land and building method, rent capitalization method, development method or residual method, profit method. Land and building method. By this method, the value of the land and the depreciated value of the building are assessed separately and added to get the present value of the property. Market value of land. The extent of the land is calculated as per the sale document, revenue documents, and physical verification at site, and the least of the two values is considered for valuation. Unit rate. The unit rates that can be applied in assessing the value of the land are: 1. Guideline rate, 2. Prevailing market rate. The guideline rate is fixed by the registering department of the government and is adopted for fixing the stamp duty for registration purpose, standard rent of building for computation of capital gain. Prevailing market rate is the rate to be adopted for assessing the present market value of the land. This is usually arrived at by comparing sale instances transacted in that area or nearby areas during that period. Components affecting the unit rate of land. It is not always true that the land area in the unit rate will give you the fair market value of the property. There are many qualities that influence the value: the shape of the topography, location, surrounding area, corner plot, town planning approved area, etc. The following sketches will show the details. Land valuation. Regular shaped land. This is the best shape for valuation, and it is a pure rectangle, and the advantage for construction is more, so 100% of the unit rate is considered in the valuation. Landlocked land. In this case, the particular land in question is surrounded by other private land. Thereby, there is no direct access to the land. It is landlocked by other properties of the neighbors. So, the property is not marketable because only the persons staying surrounding the property will be interested to buy. So this is called a landlocked property. So there are a lot of disadvantages for this property. Hence, in valuation, only 25% of the market value is considered. Research land. See, in this figure you can see there is a rectangle, and on one shortest side there is a triangle. This triangle portion is called the research land. This doesn't have the advantages when compared to the rectangle land on the side. So this research land is valued only at the rate of 60% to 70% of the market value. Strips of land. Strips of land means the width is so short and depth is too long. So this is called a strips of land, and here the valuation is done by belting method of valuation. In that, the first portion, the depth is equal to D, which has got the road access, will get 100% of the market value. Then the land behind this first belt, which is the second belt, is 1.5 D depth. This will fetch only 67% of the market value as per the valuation principles. Then the third belt, that is 2.25 D, will fetch only 50% of the market value. Go-Mughal plot. In this plot, the front, which has got the road access, the width will be very short and the width increases according to the depth. When the depth increases, the width also increases. So here, if you see, there are two recessed spots on the side. This is called the Vigra-Mughal plot. The frontage will be in full width and it will be decreasing towards the depth. Tandem plot. The word tandem itself means that one connected by the other. One property goes by the side of the other. So separately they have no value. So in this case, this bigger plot inside is far from the road, and the only access is the passage given here. So this is called a tandem plot. So there is no value for the building plot without this passage, and there is no value for the passage if the building plot is also there. That is why it is called tandem plot. In this case, the value of the passage will be less than the market value because it is giving only the access for a bigger property. Land valuation. Case 1. There is a plot rectangle in shape, length 20 meter and width 20 meter. The prevailing unit rate in the locality is 2000 per square meter. Find out the market rate of the plot shown in the drawing. It is a very simple case, the area into the unit rate. So the market value is equal to 20 into 12 into 2000 is equal to 4,80,000. Case 2. This plot consists of one rectangle shaped portion 20 meter 12 meter and a triangle portion of one side 6 meter and the other side 12 meter. For the rectangular portion, the full unit rate is given. So 20 into 12 into 2000 is equal to 4,80,000. Because the other portion is in the shape of a triangle, it may not fetch the same price as the rectangular portion. So here a deduction is made of 10%, so only the 90% of the unit rate is considered for valuation. That's equal to 0.5 into 12 into 6 meter into 90% of 2000. So that's equal to rupees 64,800. So total is 5,44,800. Case 3. This plot consists of one rectangle portion and a research portion on this side. So the rectangle portion will fetch the full unit rate, but research portion will get only 60% to 70% of the unit rate according to the shape and the topography and the location of the research portion. So the market value, rectangular portion 20 into 12 into 2000, 4,80,000. For the research portion, as per the estimate, only 75% of the unit rate is admitted. So for the market value of research portion is equal to 0.5 into 12 into 6 into 2000 into 75% is equal to 54,000. So total is equal to 5,34,000. In the last chapters, we have covered the land valuation. Now, the building valuation. The usual terms used from a building valuation is present value. That is, the replacement value minus the depreciation. Present value is also termed as the depreciated value. Replacement value is the cost of reproducing a similar building with a similar specification at the fair market price on the date of valuation. Replacement rate of construction is the cost of construction per square feet or square meter of plinth area at the current market price on the date of valuation. This is the life of each structure which is useful for the valuation of buildings. RCC frame structure 75 years to 60 years. RCC roof load bearing structure. Then Madras terrace 60 years. AC roof permanent buildings 40 to 50 years. GA sheet roof 40 to 50 years. Mangalore tile building 30 to 45 years. Depreciation. What is depreciation? Depreciation is defined as the decrease in value of a property, machinery or equipment due to wear and tear, decay and obsolescence. There are 4 methods of depreciation. Straight line method, linear method or constant percentage method. Sinking fund method, then declining balance method or diminishing balance method or written down value method. Of these 4, the main and the generally used methods are the first 2 methods, straight line method and the linear method or constant percentage method. Straight line method. The present value minus the salvage value is distributed uniformly for the whole service life on the assumption that property loses its value by the same amount every year. So the depreciation is equal to C minus S divided by N, whereas D is the depreciation each year. C is the original cost or replacement value. S is the salvage value. N is the life of the property. This is the formula for depreciation each year. D is equal to C minus S divided by N. Let us work out different cases of calculating the depreciation. Case 1. Cost of the building 2 lakhs, salvage value 10%, age of the building 15 years, life of the building, that is total life, so anticipated life or economic life of the building is 60 years. So depreciation is equal to age of the building divided by life of the building into 100 minus 10. So is equal to 15 by 6 to 90 is equal to 22.5%. So depreciation amount is equal to 2 lakhs into 0.225 is equal to 45,000. So the depreciated amount or depreciated value is 2 lakhs minus 45,000 is equal to 1 lakh 55,000. This is a simplest case. Case 2. Building area 1000 square meter, age 30 years, life 50 years, salvage value nil. Usually it is taken as 10%. Here it is nil. Plot area 2000 square meter, land rate 4000 square meter. Replacement cost of building is rupees 20,000 per square meter. What is the depreciated value? Land value is equal to 2000 into 4000 per square meter is equal to 80 lakhs. Depreciation percentage is 30 by 50 into 100 minus nil. Please note here, in the previous example, it was 100 minus 10, so it will come to 90. In this case, it is the salvage value is nil, so it will stand as 100 only. So the depreciation percentage is equal to 30 divided by 50 into 100 is equal to 60%. Replacement value 1000 square meter into 20,000 is equal to rupees 2 crores. Depreciation 2 crores into 0.6 is equal to 1 crore 20 lakhs. Depreciated value is equal to 2 crores minus 1 lakh. 1 crore 20 lakhs is equal to 80 lakhs. Value of land is equal to 80 lakhs. Depreciated value of building 80 lakhs. So the total value of the property is 1 crore 60 lakhs. Case 3. RCC 2-story building, ground floor 1,200 square foot, replacement rate 1,800 per square foot, age 16 years, life 60 years. First floor plinth area 1,000 square foot, age 30 years, life 60 years. Replacement rate rupees 1,700 per square foot. Land rate 7 set at rupees 4 lakhs per cent. Assume salvage value at 10%. Details. Details have been given for ground floor and first floor separately. Plinth area, ground floor 1,200 square foot, first floor 1,000 square foot. Replacement rate, first floor 1,800 per square foot, first floor 1,700 per square foot. Replacement value, ground floor 21 lakh 60,000, first floor 17 lakhs. Age, first ground floor 16 years, first floor 10 years. Life, ground floor 60 years, first floor 60 years. Salvage value, ground floor 10%, first floor 10%. Depreciation percentage, ground floor 16 by 60 into 90 is equal to 24%. And first floor, theoretically, 10 divided by 60 into 90 is equal to 15%. Here, note that 15% for ground floor cannot be admitted. First floor also will have to be depreciation of 25% like ground floor. Depreciation amount, ground floor 21,60,000, first floor 17 lakhs into 0.24. So depreciation amount ground floor is equal to 5 lakhs 18,400, first floor 4 lakhs 8,000. So the depreciated value, ground floor 16 lakhs 41,600 and first floor 12 lakhs 92,000. Total building cost is equal to 16 lakhs 41,000 plus 12 lakhs 92 is equal to 29 lakhs 33,600. Land value 7 cents at 4 lakhs is equal to 28 lakhs. So total for the property is equal to the land value for 7 cents plus the total depreciated value of the building is equal to 57 lakhs 33,600. Linear method or constant percentage method. This is another method of depreciation. Previously, we were discussing about straight line method. This is linear method. In this method, the capital allowance is recorded by equal proportions for every time period or interval for the entire service life of the fixed asset, or a fixed percentage is deducted every year for the entire life of the asset. The formula for the depreciation is as follows. D is equal to P into 1 minus R by 100 the whole raised to N. D is equal to depreciated value at the building. P is equal to replacement value at the building. R is equal to rate of depreciation and N is the age of the building. This is the formula. You straight away find out the depreciated value of the building. If it is separately for depreciation, the formula is different. This is to find out straight away the depreciated value of the building. Case studies. Case 1. The cost of the building when new is equal to 15 lakhs. Expected life of the building 60 years. Present age of the building 25 years. Salvage value 10%. Depreciation percentage 1.5%. What is the present depreciated value of the building? D is equal to P into 1 minus R by 100 the whole raised to N. Here we are straight away finding out the depreciated value. Depreciated value is equal to 15 lakhs into 1 minus 1.5 divided by 100 the whole raised to 25. 25 years age. So it is equal to 15 lakhs into 0.985 raised to 25. So it is 15 lakhs into 0.685. So the depreciated value is equal to 10 lakh 27,500. Here we have straight away found out the depreciated amount since the rate of depreciation was given. Sometime the rate of depreciation will not be given in the problem. In that case, you will have to assume and find out rate of depreciation as per the formula given below. Previous problem, we found out the depreciated value straight away. Now here you are the depreciation. In the previous problem, the depreciation was given as 1.5%. So here the depreciation was not given. So we are finding out the depreciation. So assuming RD is 100, this 100 is the life and this is the age. 100 by 60 is equal to 1.66%. So as per the formula, depreciation is equal to 1 minus 0.0166 the whole raised to 25. That's equal to 0.342. This is the depreciation. Depreciation amount is equal to 15 lakhs into 0.342 is equal to 5,13,000. So the depreciation amount is equal to 15 lakhs minus 5,13,000 is equal to 9,87,000. There is a difference between the 10,27,500 worked out in the previous problem and here taking the depreciation as 1.66, the amount works out to 9,87,000. This difference of 1.66% instead of 1.5% is due to assuming that the capital will depreciate to 0 in 60 years when the salvage value is nil. But since the salvage value is 10% depreciation, it will come to 1.5%. So if you work out with 1.5%, it will again come to rupees 10,27,500, same as we have worked out in the previous problem. Case 2. Load bearing structure, age 80 years, life 60 years. What is the depreciation percentage if the depreciation is 2%? Depreciation factor is equal to 1 minus r by 100 raised to n is equal to 1 minus 2 by 100 the whole raised to 8. Case 3. Load bearing structure 15 years old, 1,400 square foot, replacement rate is equal to 1,800 per square foot. What is the depreciated value of the building? Life 60 years, salvage value 10% as per straight line method. Plinth area 1,400 square foot, replacement rate 1,800. So replacement value is equal to 1,400 into 1,800 is equal to 25 lakhs 20,000. Salvage value is assumed as 10%. So depreciation percentage is equal to 15 by 60. 15 is the age, 60 is the life of the building, into 100 minus 10 is the salvage value is equal to 22.5%. So depreciation amount is equal to 25 lakhs 20,000 into 0.225 is equal to 5,67,000. Depreciated value is equal to 25,20,000 minus 5,67,000 is equal to 19,53,000. Case 4. It is a two-storied residential building, ground floor and first floor. Ground floor 1,800 square foot and first floor 1,200 square foot. Age of ground floor is 15 years, that of first floor is 10 years. Replacement rate of ground floor 1,700 per square foot and first floor 1,600 per square foot. Life 60 years, salvage value 10%, adopting straight line method of depreciation. What is the depreciated value of the ground floor? Secondly, what is the depreciated value of first floor? Number of floors, ground floor and first floor. Plinth area, ground floor 1,800 square foot. Age of ground floor 15 years. Replacement rate of ground floor 1,700 per square foot. Plinth area of first floor 1,200 square foot. Age of first floor 10 years. Replacement rate of first floor is 1,600 per square foot. Life 60 years, salvage 10%. Calculations. Details are worked out separately for ground floor as well as first floor. Plinth area, ground floor 1,800 square foot, first floor 1,200 square foot. Replacement rate, ground floor 1,700 per square foot, first floor 1,600 per square foot. Replacement value, ground floor 1,800 into 1,700. First floor 1,700 into 1,600. So the replacement value, ground floor is 30,60,000 and first floor is 19,20,000. Age, ground floor 15 years, first floor 10 years. Life, ground floor 16 years, first floor 60 years. Salvage value 10%, 10%. So depreciation, ground floor 15 by 60 into 90 is equal to 22.5%. And first floor, age is 10. 10 divided by 60 to 90, 15%. But please note here also, because the ground floor is already constructed earlier and the life is depends upon the age and total life of the first floor. The first floor should attain the full life before the ground floor will attain the full life before the first floor attaining. So the 15% depreciation cannot be admitted. The first floor will also have the same depreciation as the ground floor is equal to 22.5%. So depreciation amount, ground floor 30,60,000 into 0.225 is equal to 6,88,500. First floor 19,20,000 into 0.225 is equal to 4,32,000. Depreciated value, ground floor 23,71,500, first floor 14,80,000. Case 5. The building, plinth area 1,500 square foot, Replacement rate of construction 1700 per square foot. Age 20 years. Life 60 years. Salvage value 10%. Rate of depreciation 1.5%. What is the depreciation percentage? Depreciation amount and the depreciated value adopting constant percentage method. Plinth area 1500 square foot. Replacement cost of construction 1700 per square foot. Age of the building 20 years. Life of the building 50 years. Salvage value 10%. Rate of depreciation 1.5%. So depreciation percentage as per the formula 1 minus r by 100 the whole raised to n is equal to 0.2028. Depreciation percentage is equal to 0.2028 into 100 is equal to 20.28%. Replacement value is equal to 1500 to 1700 is equal to 25,50,000. Depreciation amount 25,50,000 into 0.2028 is equal to 5,17,140. So depreciated value is equal to 25,50,000 minus 5,17,140 is equal to 20,32,860. Sinking fund method. First of all, what is sinking fund? The capital invested in a property can be divided into two parts, namely that invested in the land and that in the building. The building is subjected to the natural law of decay due to wear and tear, with the result that the owner will start losing part of his capital every year and be left with his land only. And so, only a part capital is returned to him. If he had invested his money in other forms of securities, his capital would have been intact and he would have received the income from the same regularly. Hence, it is necessary to make some provision whereby the owner can get back his part capital invested in the building on the expiry of the building's useful life. And in the absence of such a provision, the capital will be drifted away from the property market. This loss is overcome by providing what is called the sinking fund, wherein a small portion of the rent is set aside every year and deposited in a bank at compound interest, such that when the life of the building is over, the owner can receive the full value of the building from the bank. More simply, it can be defined as an annual recurring fund, required to be set aside every year for a given period of time. At the given rate of interest to recoup capital invested in a property. Interest or return from which would cease after a given period of time. The sinking fund is as per the formula sinking fund S is equal to R divided by 1 plus R the whole raised to n minus 1. S is the sinking fund, R is the rate of return, n is equal to number of years. How to find out depreciation in sinking fund method? Under the sinking fund method of depreciation, the annual sinking fund installment to replace the current cost of construction of an existing building less the salvage value, if any, over its total useful life is calculated first. Then the actual sinking fund is multiplied by the amount Indian rupees 1 per annum for the number of years, indicating the age of the building. The result is the accumulated amount of depreciation the building has sustained at the age specified. So formula for sinking fund is equal to S is equal to R by 1 plus R the whole raised to n minus 1. The accumulated fund is equal to 1 plus R the whole raised to m minus 1 divided R. So the depreciation percentage is equal to 100 into AS. This is the formula used to find out the depreciation percent by the method of sinking fund method. 100 is equal to A into S, whereas S is the sinking fund, A is the accumulated fund. Case 1. Calculate the depreciated replacement cost of a building with following details. Prime cost of the building when new 10 lakhs, expected life 60 years, age 30 years, salvage value 10%, sinking fund rate 3.5%. Depreciation percentage is equal to 100 into A into S. The depreciation percentage formula is equal to 100 into A into S, where S is the sinking fund and A is the accumulated fund. Sinking fund formula is sinking fund is equal to R divided 1 plus R raised to n minus 1. So 3.5% is the rate of interest. So it's equal to 0.35 divided by 6.878 is equal to 0.005. A is equal to 51.62267. So depreciate percentage is equal to 100 into 51.62267 into 0.00 is equal to 25.81%. So depreciation amount is equal to 10 lakhs into 0.2581 is equal to 2 lakhs 58,100. So depreciated value is equal to 10 lakhs minus 2 lakhs 58,100 is equal to 7 lakhs 41,900. Case 2. An RCC framed structure, two-story building, has a useful life of 75 years. It is 15 years old. The current cost of construction of the building is rupees 80 lakhs. The salvage value at the end of useful life is 10%. What is the amount of depreciation today? What is the replacement cost of the building? Proceed by depreciation as per sinking fund method. The formula for annual depreciation is 1 minus SV raised to 1 by n divided by C. N is equal to total useful life of asset, 60 years. ST is the salvage value, 1 lakh. Current replacement cost of the asset is 10 lakhs. Here, annual depreciation is equal to 1 minus the salvage value, 1 lakh, divided by the replacement cost, 10 lakhs, the raised to 1 by 60. So is equal to 0.0376 is equal to 3.76%. After 50 years, the depreciated amount of 1 Indian rupee will be 1 Indian rupee into 1 minus 0.376 into 50 is equal to Indian rupee 0.563. Because the 1 rupee will become 0.563 rupees. Please go through the formula carefully. This has been arrayed from the original formula to find out the annual depreciation. The replacement value was given 10 lakh. Salvage value was given as 10%. So 10% of 10 lakhs is 1 lakh. Life is 60 years and age is 15 years. So from this formula, 1 minus SV raised to 1 by n, but divided by C. N is equal to total useful life 60 years, salvage value 1 lakh, current replacement 10 lakhs. So it will become 1 minus 1 lakh raised to 1 by 60 divided by 10 lakh is equal to 0.0376 is equal to 3.76%. Therefore, the actual depreciated amount cost of building is equal to Indian rupees 5,63,000. The amount of depreciation is equal to 10 lakhs minus 5 lakhs is equal to 4,37,000. Here you are finding the depreciated amount. Then you are deducting the depreciation amount from the replacement cost to give the what is the depreciation amount. 5,63,000 is a depreciated amount which you have found out. You deduct it from the replaceable cost to get the depreciation amount. Declining balance method or diminishing balance method or written down value method. Under this method, a constant percentage of deduction on the balance depreciated value at the end of each year during the life period of the asset is allowed. As the depreciation is allowed on the balance depreciated value of the asset each year, the amount of depreciation higher during the early days of life of this asset, while as the asset ages, lesser amount is deducted with the passage of time each year. The formula is SV by the percentage for by 1 by n is equal to Vm divided by C the whole raised to 1 by m. SV is the salvage value, C is the replacement value, n is total life, m is age, Vm is the value after m years. Case 1. Cost of building when new 10 lakhs, expected life of the building 80 years, present age 30 years, salvage value 10%, what is the depreciation replacement cost applying declining balance method. Applying the formula, the depreciation is equal to 4,21,332. Now the methods of valuation. So far we have been dealing with the land and building method. This is the other type of method usually used for building on rent. Rent capitalization method. Rental method of valuation consists of capitalizing the net annual rental return at an approximate rate of interest or rate of capitalization. Net annual rental return equals to the gross annual return minus outgoings like property tax, repairs, maintenance, service charges, insurance premium, rent collection charges, etc. In simple way, if you are getting 10,000 rupees rent per month, that is the rental income every year. So the gross rental income is 10,000 into 12 in 1 year is equal to 10,000 into 12 years. Then what are the outgoing? That is the gross annual return. From this, you have to deduct the outgoings like property tax, repairs, maintenance, etc. Then you will get the net return, net annual return, rental return. Then this has to be multiplied by certain index to get the capital value of the property. Then the development method or residual method. This method is used to evaluate such property where there is a development potential so that the value of the property after development will be increased more than the expenditure incurred. Profit method. This method is used for hotels, cinema, theatre, marriage halls and public undertakings. This method, as the name suggests, deals in the working of profit from a property and subsequently capitalizing same at the appropriate rate of return depending upon the number of facts. The rent capitalization method, development method and profit method is explained in the part 2 along with worked out examples of problems in land and building and valuate usually asked in IBB examination. Here I have just mentioned only along with the methods land and building method, rent capitalization method, development method and profit method. In that the land and building method has been explained fully with examples. The other methods, rent capitalization method, development method and profit method, that itself is a huge chapter which is being taken up with worked out example in the part 2. I express my acknowledgements and the gratitude to Sri B. Kanakasabhavadi for borrowing information available from the books on valuation, and my pranams to late Sri Roshan Namavadi, the eminent valuers, for their guidance. Hope this presentation was useful to my viewers. Please express your frank opinion, your likes and dislikes, and subscribe my channel. Thanking you.